I think that there's a lot of usage in options. The space has grown tremendously over the last few years. The options-based category has grown tremendously. And I think one of the reasons is because everybody comes to attend these types of conferences where there's education out there, and that helps. That helps people realize, well, wait a minute, I can use options for a lot of different things. It's not just a speculative type of instrument. I can use it to hedge, I can use it to enhance yield, and a lot of other things as well. Again, it comes to education. It comes for a need for yield. We've been in a low interest rate environment for many, many years, and people have discovered that you can go into the option space to create that synthetically in a way. So, and also after a 10-year bull market, people are going to want to hedge their portfolios. There's a lot of investors that are getting worried about the economy might be changing, and so the option strategies that are offered in the options-based space can cater to either income or hedging strategies. Well, there are multiple goals out there. First of all, there's income. There's the premium selling group where you're either selling puts, selling calls, or combinations via selling straddles, strangles. Then there's the capped variety where you are trading butterflies and condors. There's a lot of strategies that trade that kind of strategy. And then there's the hedging strategy where you're trying to protect downside. And then there's a mix. There's a mix of strategies out there where they are hedging downside, and then they are also incorporating income type strategies to help pay for that hedge. Well, there are multiple ways, and it really depends upon the client. Like I talked earlier today, you can move your strikes lower. That'll cheapen the cost. I think the most popular way is to incorporate some type of income program that's going to reduce the overall cost of hedging. Some programs try to market time. Some programs don't hedge the entire notional value. So it really depends upon the client. And the customer has to ask, well, where am I on this risk spectrum? Am I on a low risk, medium, or high risk type of person? And what exactly are my goals, and what am I trying to achieve? Yeah, I think there has to be a due diligence process. Some of the speakers said today, well, it's no longer about, I'm going to get you a certain return, trust me, anymore. It's more about, well, what strategies are you using? What is the mandate here? Is your primary objective hedging? Is your primary objective income? Or is it a mix? Or are you just kind of an alpha trader, which we call the anything goes? And that's really where you have to lift the rocks up a little bit and ask questions such as, are you employing leverage? Is this an actively managed strategy? Or is it a passive set and forget type of strategy? And again, what's the overall objective is what people have to figure out and see if that fits into what they're trying to achieve. We get to meet a lot of great people. The content continues to improve. It's always what's happening lately in the marketplace, and I think that's what people want to see. I used to teach options trading strategies. I think once in a while, talking about that's not necessarily a bad thing here. I think there's a big bridge of people, there's a big gap between people that are just starting out in options and may feel a little intimidated and they don't quite admit it, to people that have been trading options for many, many years. And I think what I wanted to do today is, okay, I'm not going to present a very difficult topic here, but I want people to get as comfortable as possible so that they can enjoy the next 2 days and go through some of the more difficult topics, and then they can come away with, with a lot of new insights.